Hi, welcome to our show today. Folks, we're going to talk about a lot of different things. I'm going to answer that question of why we have a retirement crisis in this country, right? Secondly, I'm going to talk about what do we need to do to retire, okay? I'm going to talk about standard deviation, that's just financial jargon, and market fundamentals. Why is that so important to follow? And finally, I'm going to talk about long-term care options. So folks, stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment, I just want to talk about a question that gets raised a lot. Why do we have a retirement crisis in this country? You know, according to the Insured Retirement Institute, 45% of boomers have no savings at all. Now, boomers are people born between 46 and 64. Now, of the other 55%, only 28% of those have less than $100,000 in savings. So you got, better than half the boomers with very little savings, relying totally on Social Security. Now, just to kind of put this in perspective, there used to be companies that had pensions. Well, in 1974 was the first that came and rolled out with the IRAs. Okay, and at that time it was a very low amount that you could put into them. In 1978, we get the first of the 401ks. Okay, so what you got happening now is you got companies getting away from pensions, now asking employees to start saving for themselves. Sounded like a great concept, right? So in 1978, you got to understand the first of the boomers were turning age 32. So what happened? Were they taught to save? If the parents had a pension plan and didn't necessarily have to worry about it, did they pass that on to the next generation that maybe they have to do some things different? That could be part of it, right? Didn't see the value of saving. Could it have been, loss of purchasing power? You've had inflation, eroding people's purchasing power, maybe wages not keeping up like they should. Maybe with all this quantitative easing we've had, maybe that's kind of devalued our dollar. Maybe what we found is that with, higher costs of living and wages and things not keeping up and loss of purchasing power, they couldn't put any money away. And then add something else to this mix. This boomer generation's had to experience two market losses where the market dropped to half its value. You had the tech bubble of 2000 through 2002, in a 2.5-year period, dropped to half its value. And then you had the credit crash of 2008, dropped to half its value again in even a shorter period of time. And that kind of wreaked havoc with people psychologically because they're trying to save, but they're a little reluctant to take on risks because they've seen the volatility of the market. Social Security was not meant to be the retirement plan. By definition, it's called SSI, Supplemental Security Income. It was supposed to just come along something else that you had, maybe like a pension, all right? Now, what do you do going forward? Well, one, try to get out of debt. You don't want to be in retirement, with any kind of debt. Can you imagine not having a paycheck and still have a mortgage payment? So work on that. The earlier you start, the better. It's never too late, so always start building that. A lot of you folks have been raising the kids, putting them through college, and now's the time. Now's the time to start putting it away. So listen, what you want to do that's even more important is plan to retire well. If you're that person looking towards retirement, you're getting there, you want to see how all the pieces of the puzzle are going to be put together, then give us a call by all means. When you look at your IRA statement or you're looking at your 401k statement, is it all yours? Think about it, because this is money that's never been taxed. Now every dollar you take out, who's there to take their share? Uncle Sam, right? Maybe in some cases, state of Michigan. You have a partner in that account. So what's your strategy to get that partner out of your account? Listen, here at Centennial Wealth, we take that opportunity to look at your scenario, look at the different ways you're going to be taking money out of those accounts, and try to find the cheapest way possible to buy Uncle Sam or State of Michigan out of those accounts. See, in a lot of cases, when you get into retirement, you're dropping into a lower tax bracket. That is a great opportunity to be moving monies possibly from an IRA into a Roth IRA, because what are you doing? You're buying out Uncle Sam at the lowest rate possible. We have to be careful, because anytime we're dealing in retirement and we're taking income, we have to look at how that income is going to be taxed. So we want to be very cognizant of what that tax liability is going to be so we can minimize taxes at the highest level. So I encourage you, give us a call. We'd be glad to sit down with you, see if maybe you're a Roth IRA candidate, maybe even talk to you about what might be the best IRA exit strategy for you. Okay, in this segment, I just want to answer that question. You know, when somebody asks, what do I need to do to retire? Okay, so I'm going to give you a number of things that you're going to want to pay attention to. First of all, the first thing you need to do is envision yourself in retirement. All right, you no longer have a paycheck. What does that look like? All right, you got to put yourself in that situation and start thinking about a lot of different things. Healthcare. You know, if I had a company paying for my healthcare and now I'm no longer working for that company, where am I going to bridge the gap? You know, am I up to the age of 65 where I can get Medicare yet? If not, where are we going to solve for that? Debt. You know, where am I at with debt? I mean, ideally, don't you want to get to retirement with no debt? Right? So, you know, where am I at with that? If I'm 15 years away from retirement and I've got 20 years left on amortization for my mortgage, maybe I'm going to want to do something about that. Social Security, when am I going to take it? We've talked about this in other segments. You know, I can take it at age 62, but it's almost double if I can wait to age 70. Can I do that? Is it desirable to work a little longer to maybe build that up? Inflation, you know, folks, you got to pay attention to this, because, you know, I can be sitting there looking soon to be retired, and I can say, I think between all these sources of income, you know, we can meet our needs. But then, you know, those needs are going to rise, right, over time. The cost of living is going to increase. What mechanism or plan do I have in place to account for that accordingly? Taxes, okay? If I'm somebody that's been putting into a lot of these qualified plans or retirement plans, and it's money that's never been taxed, and now I'm going to be in retirement and that money is going to be taxed, what have I done to account for that? What about the taxation on Social Security? You know, what does that look like? How much of that is going to be eroding, you know, my income that's going to need to be there to meet my needs? And then, you know, getting back to that, envisioning what, you know, retirement looks like. What's the lifestyle you want to live? You know, are you looking to do a lot of traveling? Are you looking to leave a large part of your assets to the kids? Maybe a legacy, maybe you're legacy minded. But what does your lifestyle look like? What is your needs? How much income do you really need? We may want to sit down there and figure what that's going to be. Sometimes it's putting the paper to, you know, pencil to the paper to figure what that needs to be. If you're going to plan for income, you need to know how much income you're planning for, right? You know, Zig Ziglar had a famous quote, you know, if you aim at nothing, you'll hit it every time. You have to plan. You have to, you know, take all these different considerations and you have to put them together to make it work for you in retirement. Now, if you're somebody that's already retired, then maybe this is the time to get a retirement checkup to make sure that all those facets of your retirement plan are playing well for you. If you're not somebody yet retired and you just want to plan, then absolutely give us a call. You want to plan to retire well, folks, so you want to have somebody help you with that.
Two great topics on retirement there, John. You know, we spend so much time on the show, obviously, with Retiring Well, talking about the various aspects of retirement. You know, with this retirement crisis out there, it doesn't have to be involving in your life. You don't have to fall into that. You know, John, I know you've been working with some folks recently here in the Traverse City office that kind of are helping themselves get out of that spot.
Yeah, exactly. We were sitting down and they're about 10 years away from retirement, and they've been saving, you know, for, well, 30 years or so and trying to build up this savings. And so I simply asked them the question of, well, what does retirement look like for you? And they hadn't ever really thought about it or ever really mapped out what that might look like. So we have the tools here at our office to be able to start mapping out, okay, if you continue saving the way that you are, and we fast forward to a projected retirement date and factor in maybe some of those assumed earnings that you'd have during retirement, in collaboration with your Social Security income. What does that big picture look like for you? And along with that, that's where those other areas come in, taxes, healthcare, and all those other pieces that play a role.
I think everybody has the dream of retirement in some way, but I think many people are fearful of taking that dive in and seeing what that actually looks like, because I think they're scared they might hear something they don't like. Well, let's make sure that doesn't happen. Let's look ahead and see what that looks like. You know, you're right, John. There's so many different factors of how that might. That's one reason why we believe in holistic planning here, so we can look at all these different things and try to maybe protect you from some of the things that may happen down the road, those roadblocks that might happen, right?
Yeah, and so for that couple that I started mapping that out, they were pleasantly surprised. They were sort of shocked a little bit when I showed them those numbers and showed them how, hey, you are able to retire when you get to that, in their case, full retirement age for Social Security, and what is that, you know, showing them what that really looks like for them and how powerful that really was.
Absolutely. You know, so if that's somebody out there like you and you would like to know that, and you're maybe 10 years away or so from retirement and want to know what that maybe looks and feels like and if your goals will be achieved, give us a call at the number on the screen. We'd love to sit down with you, have a free no obligations visit, and help you plan to retire well. If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
Hi, welcome back. Listen, in this segment, I want to talk about standard deviation. Now, this is financial jargon that we use in our industry, but I want to make you understand what it is and why you want to know more about this, okay? First of all, this is a bell curve. It's going to represent, this line here is going to represent an average rate of return of 6%. Okay? Now, why we have this bell curve is we want to understand what could possibly be the range of returns, you know, that could deviate from that average. So let's say we had a standard deviation that was equal to 10. Okay? All that represents is that there's a 68% chance that it could deviate from that average by 10%, either way. So 68% chance that we could have a minus 4% return or a plus 16% rate of return, okay? Now, in the bell curve, it also represents where the range of returns could deviate 95% of the time, but by another 10%. So in this particular case now, 95% of the time, we could see a range of return of minus 14 or plus 26. All right? Now again, based on the bell curve, represented by this line, it says that 99% of the time, the range of return could deviate another 10%, meaning we could have minus 24% or plus 36%. Now, why is that important? Let's say I'm somebody that only wants to lose 5–10%, maybe. Say 10% is the most. But based on an average rate of return of 6%, okay, and a standard deviation of 10, I could possibly lose 24%, 99% of the time, or gain 36%. So if I'm that person that only wants to lose 5–10%, but it's possible I could lose 24%, then I'm not going to be happy with that. Okay? Now what is this 1% that it's not representing? Those are black swan events. Those are unexpected things that happen that were unexpected that could drive it even farther from these ranges, meaning it could possibly lose 1% at a time, lose more than 24% or gain more than 36%. Now, look back 100 years, I dare say we've had more than just one black swan event. They happen a little bit more occasionally than we think they do, but that's what that's representing. Now, Any portfolio we can take a look at, and we can look at the whole thing and actually tell you, one, what is its average rate of return? What is the standard deviation? So you know the range that you're comfortable with. Very, very important in risk analysis. So I encourage you, if you're somebody that wants to know that, give us a call.
We look forward to helping you plan to retire well.
Hi, welcome back. Now listen, in this segment, I want to talk about market fundamentals. There's a lot to listen to out there when you're listening to the news, and everybody has their own opinion, don't they? But for the most part, you have to understand markets are pretty predictable. They'll, for the most part, will trade at a multiple of its earnings. Now, I know there's volatility. There's times when, and we've seen it in recent months, where it dropped 3% in one day. That's not what I'm necessarily talking about. I'm just saying, as a general rule, markets will trade based on the underlying earnings of the corporations. And as a general rule, historically, it's traded around 16, 17 times earnings. That means if it's much higher than that, we're most likely in overvaluation territory. And it's done that historically in the past. So, you know, if it's just done it for quite a long time, that's something we're going to want to maybe be concerned about. If it's trading below that or well below it, some might argue that's maybe bargain territory, right? Good time to buy in. But for the most part, it's going to track pretty closely with earnings, or a multiple of those earnings. So that's one fundamental we're going to want to pay great attention to. If we're in overvaluation territory, or we're in bargain territory, or if it's trading right within those fundamentals. Yeah, because if it's trading right within those fundamentals, and historically not above or below, and we're hearing a lot of bad news, is it something that we necessarily need to react to right away? It could be just a lot of emotions going on due to that bad news. Okay, so if you're a long-term investor, sticking to the fundamentals and understanding where the market's trading regarding maybe those earnings is going to be very important. Another thing to understand is when you're looking at fundamentals, you want to look at all the things that drive consumer spending, or what we call small business spending as well, because 87% of our GDP is basically small business consumer spending. So how those people are feeling about the economy, whether they're spending or not, is going to drive those earnings, which, as I just previously indicated, is then also going to drive the market. So we want to look at everything that's going to affect those earnings. For example, if we have low unemployment, why is that good? Well, it means if more people are working, they have more money in their pockets, and if they're feeling confident about the economy, they're going to spend that money, which is good for corporate earnings, again, which is good for the market. So confidence levels, how people are feeling, is something that we want to pay attention to. There's a lot that goes into market fundamentals, a lot of things we want to look at, but all the more reason you want to be talking to an advisor who's paying more attention to those kind of things. At Centennial Wealth, we do. So I encourage you, if you're at somebody and you just want to kind of see where you're at and how you're positioned relative to the market, then give us a call.
More great information there from Larry, and so often we're talking about risk when it comes to your retirement planning, and that's a vital piece that you need to consider. And so that's where that standard deviation comes into play. And Art, I know you were recently sitting down with a couple that you were talking about risk and some different interesting things you guys talked about.
Absolutely, John. You know, I was actually over in our Gaylord office with Nick Greenman, one of our financial advisors over there in Gaylord, and we were sitting down with some folks. They were very early in retirement. They had really no no financial plan. They had this 401k, they had a couple IRAs that they kind of thought were being managed, and we went through a risk assessment with them, talked about where their comfort level was, what their drawdown, what was the most they would like to see that portfolio come down. Now, John, obviously nobody wants to lose anything, but there's probably some realization of there that, okay, if I'm going to take on some risk, there's going to be some drawdown. And we walk through this analysis that we do here free of no charge to initial consultations we offer, and they were blown away with the amount of risk or drawdown that they could potentially see. John, it's been, about a year ago now, since we had the craziness of the initial pandemic with that drawdown, and looking back at what they did, they kind of chose not to look at their statements at that time. That doesn't mean that you don't have risk.
Right. That's so true. I mean, I know a lot of times we hear from people, oh, well, things weren't so great in the market, so I just chose not to open that statement or not to open that email that had my statement and everything. And that's one way of approaching it. We may take a little bit of a different approach, but it's so vital to be aware ultimately of where that, we call it your uncle point, where you say, if that's where you're starting to lose sleep at night, then you want to be aware of maybe how much risk, that maximum drawdown that Art talked about, would be really important for you to understand that if, hey, markets don't cooperate, what is your retirement savings going to drop? And sometimes people look at that as a percentage. We like to look at that as that's a dollar amount and seeing how significant of a drop that can be and how long it took you to save that amount of money.
Absolutely, John. There's so many different factors that play in a row, that the market fundamentals, the type of investments you're in, the timing, all that sort of stuff. And if you're unaware of what that looks like for you, it's get a handle on that, especially if you're earlier in retirement or even just leading up to it. It's really important so you understand that. Give us a call at the number on the screen so we can help you through the analysis. There's no charge for that. Just sit down and have a very conversational talk about that, either over the phone, through online, or in person. Stay tuned, because coming up next here to end the show, we're going to be talking about long-term care and what that may look like for you.
At Centennial Wealth Advisory, we specialize in retirement planning. Folks, we put a show together every week that we talk about a number of financial topics that are critical in your retirement planning, from tax planning, estate planning, income planning, long-term care, health care planning, and investment management. If you missed the show, then you just visit our website, go to the media tab, and you'll see the latest show.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
Hi, welcome back. Listen, in this segment, I want to talk about long-term care. Listen, if there's any question that we get asked more times than not when somebody comes to visit us, it is, do I need long-term care insurance or not? Well, the first place I want to go anytime I'm having this discussion is, what is your means to pay for that care should it happen? If I'm somebody that's saved quite a bit, and it's more than enough to cover the costs of that care when that should happen, then really do I need anything more? If I'm somebody that might be legacy minded and want to leave a lot behind and want to protect some of that, well, then that's a whole different story, right? But if I'm somebody that's saved sufficient amount away, then maybe I don't need to have any kind of insurance. We call this self-insuring. Now, just to give you a perspective of what that might look like, I've heard statistics be all over the place on this, but I've heard anywhere between 3, maybe 5 years is the average stay in long-term care. And probably the average cost being somewhere around $100,000. So what's the threat to my estate in that regard? Might be anywhere between $300,000 and $500,000 should I need that kind of care. And that's just for one person. What if I'm a couple that's even twice that? But if I'm somebody that saves sufficient amount aside to pay for that care and I can cover that, then maybe I don't need anything more. But if I'm somebody who has not, then I'm somebody who might want to consider long-term care insurance. Okay? Now, the only drawback to long-term care insurance is there's a cost that I'm going to have to incur to pay for that insurance. It's a cost that might rise as I get older. Some do, some don't, but it may be one that grows the closer I get to needing that. The other negative maybe with long-term care insurance is that it's a use it or lose it. You know, I'm going to pay for that insurance for quite some time, and then I get close to maybe needing it. Maybe I can't afford it, and now all those premiums I paid have gone for naught. But today, folks, they have what they call hybrids, and hybrids are the ability to take a segment of your savings, put it aside for that kind of care. Maybe it's a lump sum. It goes aside for that care, and then it's insuring me for that benefit. And then if I don't need that long-term care, there's usually some kind of a risk, or I should say a premium payback. Okay, that might, you know, it's not going to get the kind of growth you might have had maybe in an investment account, but at least it's a return of premium. I get a lot back of what I set aside. So there's a lot of different features with these hybrids, but it's something, just see another example with life insurance. You know, it's got a death benefit, but can be used for long-term care. And then if you don't need it for long-term care, at least it paid a death benefit out. So a lot of different features here, a lot of moving parts, but it's something you might want to check into, because if it's not typically just long-term insurance, maybe it's a hybrid that might be more beneficial.
Wow, great information here on retiring well. You know, Larry dived into long-term care. I think, John, this is one of those things that nobody really wants to talk about because it's not really a fun conversation when you're entering those, but most of us have known somebody that's ended up in those spots. Statistics say, you know, the chances if you're a married couple, probably one of you, if not both of you, may end up with there. And there's different ways to battle that, right, John?
Yeah, it's one of those hot button retirement topics that you want to be educated on. And one of the areas that I know Larry didn't dive into is dealing with life insurance with these accelerated benefit riders, or basically long-term care benefits, where you can access the death benefit early to help pay for long-term care. And if done properly, that could be done in a tax-free environment. So we've used it before. There's a couple that was basically approaching that age of now 72, where required minimum distributions come into play from their IRA accounts. And they were basically finding, hey, we're not going to be spending that extra IRA income. It's just going to go sit in a savings account. And so we looked into, hey, what would it look like if you were to get some type of life insurance policy that then would allow you to draw that death benefit early if needed for long-term care, and ultimately if you end up not needing it for long-term care, there's a tax-free death benefit left behind. So there's a lot of different things out there that you want to pay close attention to, but it is an option to consider.
Absolutely, John. You know, you made me think of another story here that I just was having. Some folks I sat down with had this life insurance policy they've had for what they said forever, but many years. You know, life insurance has changed dramatically over the years, as it always does, as most things do, right? But with mortality tables changing and different benefits being offered, you know, we were able to take this old life insurance policy they had that had an okay death benefit and roll it over and replace it with a policy that then offered them long-term care benefits. And it ended up being a pretty simple process. Luckily, they were healthy and they were able to do this replacement. And John, one other story I was thinking of too is I just sat with this client here. It was a single female, and she was inherited some money, and it was after-tax money, and she had no plans of using this for income, but she really wanted to protect her children in case she went into a nursing home. There's products out there that you can stash some cash into these. They have some decent interest rate crediting, some liquidity options, and John, you know, it really protected her and it helped put her mind at ease.
Thanks again, everybody, for tuning in to Retiring Well.